Alright guys, welcome to my new video. Today what I really want to cover is basically how to use simple moving averages on swing trades. So we're going to be using the 20-day, the 50, and the 200-day simple moving average to show us levels of support, resistance, and signs of uptrends or downtrends. I'm going to show you how to use them in combination with the MACD, which is an indicator, a technical indicator that you can add on some platforms. Not sure if it's available on all platforms, but I'm using Thinkorswim, so if you have Thinkorswim, it'll be there. If not, you can use stock charts for swing trades, and MACD will be there. So with combination with the RSI, MACD, and 20 days and the simple moving averages, I want to show you how to utilize all of it to identify a good position and purchase a stock to go long. So when we go on our screen here, basically I'm under the swing trades watch list. This is my watch list for swing trades, and I have in my study section here under sets I have day trades and swing trades. So swing trades, let me cover this because that should not be there. So let's cover that. Perfect. Alrighty, so now I don't have to blur it out. Okay, so like I was saying, under studies I have basically two sets of indicators, one for day trades and one for swing trades. And for swing trades I basically use, these are the indicators that I use with the current parameters. So simple moving average, and I set it to 20. So once you add 3 simple moving averages, which you can do by going to studies and searching for simple moving average, select that and it'll add it to your price category for your studies. So once you have 3 of them there, you go to settings and then you change the length to 20. Now that'll calculate 20 days of data. If 20 days of data, and it'll put the price, it'll put the line at the price of an average of 20 days of data. So it collects the prices of all 20 days and gives you an average price, and that's where it comes into play. So I have it set to green, the color. This one 50, so set the length to 50 for 50-day moving average, and I have it on blue. And 200-day simple moving average, which is the length, and I have it on red. So basically the simple moving averages, the shorter the time span, the closer it will move to the trend. So as you can see, the 20-day, which is the green as we identified previously, moves a lot closer to the trend because it only calculates 20 days of data. So therefore it moves closer to the trend. 50 days is a little bit further, so which also could be used to identify levels of support as it did here. So it came down. This is EVER. I forgot what type of what stock this is, but let me search it up for you here. EVER. I have no idea where I saw that stock, but search it up, do your research on it if you want to know more information about it. So we see here that the price went down and it hit support on the 50-day simple moving average, and then it shot up, and let's see the percentage change here, where I can get my, I do have my trend line, so why isn't it? Okay, right here. So when it shot up 50%, so yeah, that doesn't need any explanation for that. Shot up 50%, so if you would have invested whatever amount you would have invested, you would have made 50% of whatever amount you would have invested. So going back, so that's the 20 and the 50. So as you can see, it moves close to the trend. The 50 is a little bit spaced from the actual trend, went down, hit support, and shot up. This doesn't usually work all the time, you know, sometimes it'll come back down, and that's where the 200-day simple moving average comes into play, because this one acts as support when the trend starts to go below the 50 and the 20. So I'm going to show you a downtrend so you can see how the simple moving averages, the 20 and the 50, react to a downtrend. So right here, we identify it's an uptrend because the 20-day and the 50-day, the 20-day is above the 50-day, so it's in an uptrend, and they're below the trend. So that's what we want, and you'll understand why I say the 20-day is above the 50-day later on when I show you the downtrend. So let's do a stock that's downtrending. Let's see. Actually, okay, perfect. So here we see in this stock, same stock, that there's a downtrend, right? What happens here? The 20-day and the 50-day are above and they cross each other. So the 20-day is no longer on top of the 50-day. So usually when they cross, it's indicating a downtrend is starting to form. So you may want to sell your position. And as it did consolidate for quite some time, then it started its downtrend, gap down, and there we go, until it actually came above the 20-day and then crossed and then started to uptrend from there. So as for the MACD, I like to use it in combination with the MACD and the RSI. So the RSI shows you if a stock is overbought and oversold. If it's overbought, it'll be above this 70 I guess percentile or line. I'm not sure what the term is to describe that, but if it's above 70, it's overbought. If it's below 30, it's oversold. So if it's oversold, it means basically that the stock is devalued by overselling. So people are selling it too much and it's at a price where each share is cheaper than the actual value of what each share should cost. So that's good to know. So if, let's say over here where it was oversold, we see that it did indicate that was a low, and it started to uptrend from there because it was oversold. So, and then once a confirmation with the 20-day and the simple moving average, the 20-day and the 50-day simple moving average confirmation, when they cross, it started to rise, it spiked up, and then it started continuing on its uptrend. So we are, if you didn't notice before, we're looking at the 1 year, 1 day chart. So each little bar is 1 day. So, and this right here is just 1 day. So yeah, quite a bit of percent on just 1 day. So the MACD. So basically you can use this in multiple ways. This just shows you the momentum of the stock, if it's going down or if it's gaining momentum. And usually when it gains momentum, the price goes up. Usually when it loses momentum, the stock price goes down. You can use, I guess, I'm not sure how to explain it, but it's a divergence. So I'm not seeing here. Let's see if I can pull up an example. But here, let's go to Snap, because that stock did a perfect divergence. Okay, so here you see that this point is higher than this point, or this point is lower than this point. But when we match it down to the MACD, we see that this point here is lower than this point, or this point is higher than this point. And what this is indicating is that the momentum, the downward momentum, is fading and starting to build upwards momentum. And that's exactly what it did here when the MACD lines crossed. So the MACD crossed the signal line and began a bullish trend. So if you would have bought here at 42, which was the all-time low, which was basically exactly where the divergence occurred, and then you would have sold up here at $18, that would have been, if I could get this, there we go, that would have been 254% on your money. So over the span of how many months this was. So this was probably in December, so this was about 7 months. So as you can see, you can utilize the 20-day simple moving average, the 50-day simple moving average, and the 200-day simple moving average as well as the MACD and the RSI to kind of form a better indication on whether you should buy a stock at that price or sell a stock at that price. So I hope you've learned quite a bit from this video. We covered the simple moving averages, the MACD and the RSI, how to use them in combination so you can purchase your stock and be well informed on where it may go in the future. So if you like this video, please give it a thumbs up. Please consider subscribing, and if you have any questions, please leave a comment down below, as I'd like to read them and answer any questions that I have an answer to. So besides that, I'll see you guys in the next video, and peace.